Welcome to part 2 of the IAS 1 presentation of financial statements video. Statement of profit or loss and other comprehensive income. This statement includes profit or loss for that period plus other comprehensive income that is recognized within the period. IAS 1 Separate disclosure of owner changes and comprehensive income. The statement of comprehensive income shows income and expenses to be reported in either the one statement, which is a statement of comprehensive income, or two statements, where there is an income statement and a statement of comprehensive income. Therefore, other comprehensive income in terms of the two-statement approach is to be reported separately from owner changes in equity. And this was changed to have the option of two statements to increase transparency of equity changes. Certain items must be shown on the face of the income statement. The minimum requirements for these line items are as shown in the next slides. An entity should provide an analysis of expenses using a classification based on either nature or function. This should be performed either on the face of the income statement or in the notes, though presentation on the face is encouraged. The following statement presents profit or loss by function. Expenses recognized in this statement are analyzed by function, such as cost of sales, selling, administrative. If an entity categorizes by function, then additional information on the nature of expenses, at a minimum depreciation, amortization, and employee benefits expense must be disclosed. Moving on, if profit or loss, the expenses are presented by nature. In this case, you have classifications such as raw materials, staffing costs, depreciation, etc. In terms of presentation of the other comprehensive income, this particular statement is an example that shows other comprehensive income presented gross of tax. That is, the effects of taxation are shown as one lump sum figure. This particular statement also shows other comprehensive income, but in this case, they are presented net of tax, which means per line item, the effects of taxation have already been accounted for. An institute should present as a separate component of its financial statements a statement showing net profit or loss for the period, each item of income and expense, gain or loss recognized directly in equity and the total thereof, cumulative effect of changes in accounting policy and the correction of fundamental errors per the IAS 8 benchmark treatments. In addition, an entity should present either within the statement or in the notes capital transactions or distributions to owners, accumulated profit or loss, balance at the beginning of period, balance sheet date, and movements for the period. A reconciliation between carrying amount of the following at the beginning and end of the period should also be presented. Each class of equity, share premium, and each reserve. All of this can be shown within the statement of changes in equity. The statement of cash flows. In this statement, cash flow information provides users of the financial statements with information to assess an entity's ability to generate cash and to also indicate how it utilizes the cash in its operations. The requirements for the presentation of a statement of cash flows are set out in IAS 7, Statement of Cash Flows, and they are also noted in brief in the course on the conceptual framework. Notes to the financial statements. The notes must present information about the basis of preparation of the financial statements and the specific accounting policies used. This is key, as some of the standards require an entity to choose between some options regarding how it applies the particular standard. They should also disclose information required by IFRS that is not presented elsewhere in the financial statements and additional information that is not presented elsewhere. Notes should be cross-referenced to the item to which they relate. IAS 1.114, which is IAS 1 paragraph 114, suggests that the notes should normally be presented in the following order: a statement of compliance with IFRS, a summary of significant accounting policies applied, and supporting information. The notes should also cover other disclosures, including contingent liabilities and unrecognized contractual commitments, as well as non-financial disclosures such as the entity's financial risk management objectives and its policies. The company should also disclose judgments. The notes should also show disclosure of key sources of estimation uncertainty, and these disclosures do not involve disclosing budgets or forecasts.